welcome back to the 2022 Alternative Marketplace, Africa's home for the top investment managers in the alternative asset class space. And we're on to our second manager after a great opening presentation from Safira. An excellent entry point into the world of hedge funds. Laurium Capital is an employee-owned boutique asset manager, was founded back in 2008, and it's one of the leading hedge fund managers in South Africa with a 13-year track record. Laurium manages 3 hedge funds, a market-neutral hedge fund, a long-short hedge fund, and an aggressive long-short hedge fund. In addition to hedge funds, Laurium also provides a suite of long-only fund strategies in South Africa and the rest of Africa, with total assets under management of 39 billion rand. And we're joined today by Murray Winckler, co-founder and portfolio manager of Laurium Capital. Murray, over to you.
Thanks, Michael, and good morning, everyone. A little bit about hedge funds and why you should be invested in hedge funds. As Michael said, we've been going for 13 years. We run 3.5 billion of hedge funds. We run 40 billion in total. But hedge funds are very much underrepresented in South Africa. We have a team of 29 individuals. We have 15 on the investment side. And we're large enough to be relevant to people, but small enough to be nimble. So why use hedge funds? Firstly, I guess if you're a long-only manager, all you can do is you either buy a stock if you like it, or you hold zero in the stock if you don't like it. Being a hedge fund, you can actually take it a little bit further. You've got more tools in your toolbox. So if we don't like a stock, let's assume it's Shoprite. Shoprite's trading at 220 Rand. We think it's too expensive. We can then sell that share and hope to buy it back at a lower price. If we buy it back at 220, at 200, we actually end up making an extra 10% by putting that position on. So there are some extra stuff you can do for very expensive shares. In addition to that, we're able to hedge out our portfolio. We run with a lot of put options. Downside protection is something we do as well. Very important for hedge funds relative to long onlys. And then being fully exposed in a long-only fund, you have to sell something to buy something. Hedge funds, on the other hand, are able to just, because they sit on quite a bit of cash, at any time you can buy a share, sell a share, and you don't need to worry about that. And your opportunity set is much bigger. So some of the myths out there in hedge funds are they're not regulated, a black box. That is true. There has been some worries internationally, but South Africa is regulated by the FSCA, and we have been for 5 years now, 6 years, and so it's very tightly regulated in South Africa under the Unit Trust Act. In addition to that, hedge funds are seen as high risk, which is globally there are 9,000 hedge funds out there. Some of them are very high risk, some of them are moderate, but in South Africa as a whole, hedge funds being regulated are much lower risk. So that is one of the things that is quite different in South Africa. The other thing is hedge funds don't add value. The fees are very high. Now, that's true. 1 in 20 with a cash hurdle is high, but you have to look at your net returns. So returns after deducting your fees. And the South African industry has done extremely well over time. And net of fees, we've matched the markets or beaten the markets at lower levels of risk. So one of the big benefits of being in a hedge fund is downside protection and risk management. What we have to my left is the 2 crises we've seen in the last 15 years. One, firstly, far left, is a global financial crisis, and we show what the market did at that period. Overall, the SA market went down 37% during that crisis, was the max drawdown you could have lost, and the average hedge fund in South Africa only went down by 15%. So there was a huge benefit to being in hedge funds. You didn't lose nearly as much money in that drawdown. We show over there the three months where the markets went down fell sharply. You can see sort of the first bar chart negative there, the red one, -9. Then that was in July 2008, and then the next one was in September 2008 and October 2009. And those drawdowns were 13% and 10% in that month. We show the average long-short fund in South Africa generally fell at about 2.5%, and the average market neutral was very flat during that period. So big downside protection by hedge funds. And then we have a look at the latest one, 2020, the COVID crisis. Again, the 2 months, February and March. And you can see 9% downside for the market and 16% for downside for in the March month. And the average hedge fund was down probably about 7% in each month on average. So it protects on the downside. Very beneficial. So where is the smart money invested? If we look globally, the hedge fund industry is $4 trillion. Locally, we are a small amount of $5 billion. So we are absolutely tiny. Now, all the endowment funds globally allocate hugely to hedge funds. If you look at the Yale, Princeton, Harvard, Brown University, they are allocating somewhere around between 20 and 35% of their allocations go to hedge funds. So we in South Africa are way behind the game on this. A little example, a chart here shows the property index, which was extremely good over time, and great returns. In 2016, looked very expensive. We went short that, a couple of the stocks there, Resilient, Fortress, and it was a little bit early in going short, so we sold it with anticipation of buying the shares back. And what happened is the market then, you can see in 2018, fell very sharply, fell by some 30%, and we profited from that, which long-only managers, all they could have been not in there. We made a lot of money from being short. Having a look at the hedge funds out there on the chart, we show the returns of our funds since inception, 1 August 2008. The diamond there, relative, we've beaten the all-share index since inception at a third of the vol. At 2/3 of the vol, and our market neutral has done the same return, slightly above at 1/3 of the vol. And then if we look from when we started our aggressive hedge fund, how we've done on that. Again, our aggressive fund has done double the market. This is all net of fees. And the returns there, so showing on a risk-adjusted basis, very attractive returns. Lastly, just on positioning of our funds, our long book at the moment, we're sitting on some British American tobacco, quite a few of the resources. On the short book, we're quite underweight banks at the moment, sort of relative to the index, and a couple of shorts in the retail space. And then we're on the long book, a couple of special situations like Steinhoff Prefs, some of the smaller industrials, Invicta, Hudaica, etc. So that's just a little bit of flavor of the hedge funds and performance, and saying have a closer look at them, because we think for the industry as a whole in South Africa, we should have a lot more money in the hedge funds. And hopefully some of that includes the Laurium funds.
Murray Winckler, thank you very much. And it's very interesting to hear that you short some of the banks at the moment. I'm going to take you aside and unpack that thesis. But firstly, how did your hedge funds do over the last 12 months?
2021 was a very good year for us, and we'd been a bit pedestrian a few years before that. But our aggressive hedge fund did net return of 49% after fees last year, and our main long-short fund did 33%. Now, bear in mind, the market itself did about 27%. So we were comfortably above in our main long hedge fund, and in our aggressive one, we did extremely well.
Now, you mentioned that there's still an under-allocation to hedge funds in South Africa. You know, collective investment schemes at 3 trillion rand industry assets. Why do you think hedge funds still remain such a small allocation in the South African context?
I think one of the things is the regulation for the industry, which only came about that's 5 years ago. And then in terms of being on list platforms, it's not on all. It's getting on those platforms has been quite difficult. And then some of the IFAs not having licenses to sell the product has been an issue as well. So those have all held back the industry quite a bit. Nevertheless, it is picking up, but there's still a long way to go. And I think the complexity is another big issue, that people out there don't fully understand hedge. So the trick on that is to look at the people with track records of 10 years plus. You can see the returns, you can see the vol, and there's a handful of guys who've been around in our industry that have got really good track records over 10 years plus. And those are the ones that one should look at with the history.
Now, how much do you think investors should be allocating to non-traditional assets like hedge funds and other alternatives?
Look, it's part of diversification, always very important. I think if you add a bucket of 10 to 20% to your hedge funds in your total portfolio, I mean, you see the Ivy League endowment funds are doing 20 to 35. So 10 to 20 seems a pretty decent number for us. And if you put those in and then you look at the risk return profile by adding in your returns, your risk adjusted returns should definitely improve by doing that. So 10 to 20 is the number we would think makes sense.
You said the challenges around the list platform. How can investors access your funds?
The one easiest is to go onto our website. You can access directly. You can go onto Hollard. You can go onto Glacier platform. But it's probably the best is to get in touch with us at Laurium, Kim Hubner, who runs marketing and that, or just go straight onto the website and we can help you on that.
Well, there you go, folks. Hedge funds, I know for a while had a bad rap around fees. That certainly isn't the case when you look at the returns that you get, net of fees as well as gross. If you're allocating to the right investor, and I think Murray made that point. Look at those managers, I should say, with track records of 10 year plus. That was Murray Winckler, co-founder and portfolio manager of Laurium Capital, an employee-owned boutique asset manager. As I said, founded back in 2008, so it's been around for 13 years. One of the leading hedge fund managers in the country.